We're going to turn now to business and finance news and invite Suzanne Haddan from BFG Financial Services to join us here on Weekend Breakfast. Suzanne, it's lovely to see that you got the memo about the wardrobe.
Yeah, snap.
I feel like us pink ladies could could join the cast of Grease or something like that together.
Or at the very least celebrate the low unemployment rate for women.
Indeed. In fact, let's talk about that. Indeed. The unemployment rate stayed at 4%. These were the figures that came out this week. We saw 18,000 jobs, though, added to the economy. Now, it is a very tight labour market at the moment, which could lead to a discussion about whether we're going to have competitive wages and maybe even better working conditions in the coming months.
Well, we're certainly hanging out for those wage figures, which will come out in May, the next update, but it is very tight. You're looking at the highest advertising rates at the moment. Most businesses will tell you it's pretty tough to be hiring people, which is great for the economy, but it does get us thinking about what that may mean for when the Reserve Bank is likely to raise interest rates and the good, the bad and the ugly outcomes of that situation.
Absolutely. So, a lot of analysts are saying there's a very strong possibility the RBA will probably raise interest rates after the election. Do you think it's going to be a steep rise or will it be a gradual one?
My feeling is it's more likely to be a gradual one because they will be conscious of the effect it could have when you think about the bad on the borrowers. You have a situation where about 60% of the loans out there are variable interest rates. And let me tell you, I think the banks will pass on any increases pretty quickly. But you also have 90% of fixed rate loans will be coming off that rate within 2 years. And while the Reserve Bank Financial Stability Review released this week did say they feel most households are in a pretty strong position, you can't say that about all households. Think of first home buyers. They could be looking down the barrel of 2-3% increases in their interest rates, and that's got to be a concern.
It certainly will be, it'll hit hard on the household pockets, obviously. We talked about the bad here and the people who will probably suffer from this increase in the interest rates. Who will win? Who is likely to benefit from this rise?
The real winners will be those that live off their savings. Think about those that are retired. They have been suffering extraordinary low rates of interest over the last couple of years. I think what concerns me there is the divergent interest rates that are available. I strongly suggest people shop around. At the moment, one of the big four banks is offering as low as 0.15% on your money for a 12-month term deposit. A competitor is offering 1.95% for the same period. So think about someone retired that might have $100,000 in a term deposit. That's a difference of $150 for the year, or nearly $2,000. You just don't seem to be getting rewarded for loyalty. And remember that the government does guarantee your term deposits up to $250,000 with each of the major institutions and the credit unions and building societies. So there's not really even a risk argument for why you're not shopping around at this point with such good rates being on offer.
All right, so let's continue on this trend of shopping around for, a better offer or so. But then I want to come back to maybe the first home buyers or people who may be mortgaged up to their eyeballs with an eye on these interest rates rising. What can they do now?
Okay, so what they should seriously look at doing is, if they cannot afford a major rise, because it could get to 6 or 7% over coming years for your loan repayments, they should consider whether they fix some or all of their home loan at the moment. Now, I absolutely understand that the variable rate at the moment might still have a 2 in front of it, and the fixed rate might have a 4. You're not actually doing this to save money. You're actually doing it to make sure the household budget can deal with a shock if interest rates do increase more rapidly, Fauziah, than we're expecting. The other concern for first home buyers, as you say, the ones tend to be debt up to their eyeballs, is what we call negative equity. And when we get interest rate rises, you tend to see a bit of a softening in the property market prices. So they could be in a situation where their loan is higher than the value of their property. Now, if they're happy with their home, if they've got job security, and with the unemployment rate at this level, I think that's a good bet. And they also can meet the current payments or the fixed rate payments. They don't have to be concerned, but they have to really negotiate with their existing financial institution, because as your property price drops, it's very hard to then move your loan because the security ratio isn't correct.
Yeah.
So don't put your head in the sand, get out, check where you're at and go and talk to your financial institution now.
Very good advice there, Suzanne. Always great getting you on Weekend Breakfast. Thank you so much for chatting with us today. Suzanne Haddan there from BFG Financial Services, and my pink sister.
Go girls.
Thanks, Suzanne.